Okay, hello everyone, and welcome to another episode of Squared Financial's educational webinars. Today we're going to do the sixth episode. We're going to look at powerful strategies. Okay, let's start. Please, today I'd like to have this this session a little bit more interactive. So feel free to ask questions while we're going through the slides or the charts. Okay, so today we're going to do much more in-depth knowledge of trading and technical analysis. We're going to look at reversal strategies, how to identify reversal strategies, as well as trends, if it's a trending market or a ranging market. Okay, so everybody is ready. I'll share my screen. Okay, I see there is quite a lot of participants, so please feel free to ask any questions. If I'll read them, and I'll read them out loud, and I'll see if I can answer them straight away. If they're too detailed, then I will leave them till the end, all right? Okay. Everybody can see my screen, right? Yes, excellent. Okay, so reversal strategies, breakout breakdowns, very important, breakout breakdowns and candle signals. Now, just a recap for last time. Last time we saw that if you don't, we learned that if you don't find a setup, a good setup, might as well not trade. And there's nothing wrong with not trading. Sometimes I go many days without trading, and there's nothing wrong with that. I'm behind my screen, I'm doing the research, I'm looking for nice trading setups. I don't find any, or I find some, but I'm not too convinced of, so I skip the trading day. And I used to, a long time ago, 10 years ago maybe, I used to itch a lot and I used to want to trade a lot. However, with time, you realize that this need for trading is sometimes it comes from a need to, like any other job, like a need to do something and to feel productive. However, feeling productive in trading sometimes can lead us to lose money. So if you don't really find a nice setup with a nice edge that you feel you have a competitive competitiveness over, then not trading is a better option. Okay, so let's start with reversal strategies. Okay, we saw last time, plan a trade, trade a plan, right? So if I don't have the plan trade in advance, don't rush into the button, the buy or sell button. So first of all, let's look at a trading checklist. Trading checklist. We have to have all these checked prior to entering the trade, not entering the trade like some traders would do. They would enter the trade and then start looking, okay, did I meet this checklist? Did I fulfill all my rules? Okay, so trend identification. First of all, we have to identify if it's a trending market or a ranging market. Correct? Okay, someone's asking a question, how can I access the old webinars? We will post them soon online. So as soon as they are, if you are registered already with us, hopefully you open the demo account as well, so we can, so I can personally follow your steps, your learning steps, and then get to see how you're trading on a demo account. So Patton, if you want to access the old webinars, we'll send you an email whenever they're online, okay? So the trading checklist. So market is trending or market is ranging. You have to identify this first, because if a market is trending, some indicators work that do not work when a market is ranging, right? For example, the moving averages that I use, the near-term moving average that I use, for example, on a hourly chart, which is the 20-period simple moving average, does not work when the market is ranging, right? So I have a lot of students who would tell me, but I went in when the market was my price was above the moving average and the market looked like it was going up. If it looks like it's going up, but obviously we're looking at it now and we're going to see some charts and we don't see a trending market, then this moving average doesn't work. Doesn't matter if the price is above it or below it. Okay. And another checklist is my entry signal. Do I have my fundamental catalyst? We spoke last time of a fundamental catalyst. If there is a, for example, what did we have today? Today we had the German IFO, for example. Was it good? Was it bad for the market? Again, we saw last time that we learned last time that we shouldn't overcomplicate things, that we shouldn't overanalyze things. However, it's important to know what's driving the markets, what's pulling the buyers or the sellers towards a currency pair. Okay, and another checklist for my entry signal, obviously, is my technical indicator signal, which is a confirmation to the fundamentals. Okay, and then finally, the exit strategy, the exit checklist, sorry, which is what's my target? Has it been reached? Or has my trailing stop loss been hit? So either or. It doesn't matter if it's 50-50. Sometimes we have 50% of our trades are good, 50% of our trade, our stop gets stopped, okay, gets hit. It doesn't really matter. Some traders have even higher bad trades than good trades, however, make a lot of money. And as I mentioned last time as well, not last time, maybe one of the episodes, I mentioned the person that used to trade alongside with me in one of the trading floors I used to trade at a long time ago. And this person had, let's say, 2 or 3 out of 10 trades positive. Okay. However, he maximized the profit so much that the other 8 or 7 bad trades were nothing compared to the good trades, and he was part of the green team, one of the top 10 on the trading floor, where we were about 50 to 60, and he was top 10, meaning, he was making millions plus annually. Okay. So it doesn't really matter as long as we learn how to accept our losses, cut them when we have to cut them according to our rules, and then let our winners ride. Trending market. Okay, so how do we identify a trending market? Simple: higher highs, higher lows. Okay, we saw also this a couple of episodes ago. So higher highs, higher lows. We're going to see an example of that again. And how do I identify a ranging market? 2 points plus make a support or resistance level. So I draw my support resistance level based on 2 points where the market has stopped or reversed. And confirmation is usually the moving average, right? Because a ranging market, when does it start? It starts following a trending market. So so the market is, let's say, trending up or down, and something happens, a resistance happens if it's trending up, and then it stops, it corrects, there is correction. It's not a reversal, it's just a correction, a pullback. Then there is another support level. Usually it's the moving average because the market is trending up, and then it does it again, and it doesn't break a new high. So we do not have a higher high. And then usually the market either reverses and starts trending down or becomes a ranging market. Most of the times it becomes a ranging market. Why? Because after a trending market, let's say a trending up market where the bulls or the buyers have the upper hand, then the sellers come in because the price reaches a certain level where it's attractive enough for sellers to come in. And then there is an equilibrium, a balance between sellers and buyers for quite some time before the next battle, if we want to call it, before the next trend happens. It's either a trend down. Most of the cases after a consolidation period, if the trend is going up, it's also, in my experience, most of the times it's consolidates and goes back up, unless a fundamental catalyst reverses the market. Okay, so trending market, this is a trending market. We have a low, a high, a higher low, so there is a correction here, However, does not go below that initial low, and then it goes higher, higher low, higher highs. Okay, the same thing, the opposite. Downtrend starts up there, goes down to a low, correction or pullback to a lower high. It does not reach the previous high, and then lower low, lower high, and lower low. So these, if we see this, and with experience, you'll learn to identify them as soon as possible. And it doesn't matter if you don't for now, because wherever you get in this trend, whenever your entry point is, even if it's too late, you're right on trade. Okay, so it doesn't matter if you're too late and you lose money when you're right on the trade. And that's the difference between being right and being wrong. I'm right, however my entry point was bad, I got out. It doesn't, you're not as angry, and trust me, you won't be as angry as when you're wrong on the trade, when you get in without any perfect, without looking or waiting for a perfect setup. You get in and you get out, and knowing that you have a higher probability of losing, you know that in advance, yet you went in the trade. And that's a mistake that a lot of people that I know, or a lot of aspiring traders that I know or that I coached do. Okay, a ranging market again. Ranging market cannot be perfect. Okay, as we see here on this slide, we see a chart with, okay, this is called the first blue candle. We learned last time that we call it a wick or a tail or whatever. I call it a wick, and usually I do not take into consideration these wicks. So I would draw my lines a little bit below that wick. Why? Because this wick is usually something that happened, a panic reason for a price going up or going down. Okay, and what it means is, usually it means that the market went up and then the buyers stepped in, brought it back down, and there was a balance, as we mentioned earlier. Okay, so it doesn't need to be perfect. It's not, if you read on one of our daily morning outlook, if you read the resistance, let's say on gold is 1971. Don't be, it's not exactly 1971. I would rather, when I put support resistance levels, I put a zone or an area. However, we can't put that on a morning outlook, because there's no space. Otherwise, we have to put the support is the area. The support is between this and that, and the resistance. So we put a where we think, or where we drew the line. However, a couple of pips higher or lower is not, So 1971 resistance, it goes up to 1975 and then pulls back down. It's still stopped at that resistance, or the resistance is valid. Okay, so this is a breakout breakdown, very important. This is following a ranging market, not a trending market. So the market is ranging, and then we identify it by looking at these points here. We set 2 points or more, right? So this is a resistance, point number 1, point number 2, and then even point number 3. So it's even a harder to break resistance. And then the breakout. And usually what this breakout means is don't sell, unless, of course, there's always a fundamental catalyst, unless there is something happens along the way. For example, it could break out, and then the next day's fundamental catalyst attracts sellers and push it back down. But remember, trading is never 100% accurate. We want to have the edge on our side. So usually when it breaks out like that, it means the market is going to start going up. The confirmation is usually, ideally, the confirmation would be that this price right here pulls back to the new support. I wrote here new support because it used to be an old resistance. It pulls back to this new support and confirms to us that this is now a support level. Okay, so let's go. First of all, before we continue to the candle signals, let's look at a chart, for example, a live chart, and not some slide that I included a couple of days ago. Okay, and then this is the chart we're going to look at today. First of all, I have to unshare my screen, and then enable sharing again. And here we go. Okay, everybody can see this. What is this? This is the 4 hours Euro USD chart. Okay, everybody's cool. Am I sharing the right screen? Euro USD 4-hour chart. Thank you, Kareem. Okay, so Euro USD 4-hour chart. You also see my mouse, okay? So let's look at this chart for a second. Is it a ranging market or a trending market? So first of all, we'll have to identify that, okay? It doesn't look like a trending market at all. Let's go back a little bit. So here we have a trending market, trending up, right? A very obvious, beautiful trending market up, okay? So let's analyze this for a little while, okay? We're disregarding fundamental catalysts now. We're not going to go back to, for example, on the 10th of July, see what happens for this breakout to start. Okay, so let's just look at the technicals for now. And most importantly, the candle signals, that this is what this episode is about, how to be able to read the candles. We mentioned last time that we don't have the tools or the information that a market maker has. However, we want to trade or be able to trade like a market maker or think like a market maker. So we try to analyze these with the tools that we have in front of us. Powerful tool, which is the chart and the technical analysis. This is an extremely powerful tool combined with fundamental analysis and discipline. Of course, it makes trading extremely easy. And yes, I know it looks easy on a webinar. However, trust me, I have experience. I started trading in 2001, so I have almost 20 years of experience, and I know it is easy. However, I see the mistakes, the typical mistakes that 85% of us do, and that's the reason why we think trading is so hard. It's extremely hard. There's no way you can make money with this. This is pure luck. You're fooled by randomness if you think that this is there's any skills to that. Well, we also went through skills versus luck slide on the last episode, or the one before that, and we know for a fact that it is more of a skills or a talent job, because the guys or the people that keep making money trading year after year after year after year we know them. Okay, so for example, the best fund manager is very well known. He's been the best fund manager. He's there's a competition between fund managers. Whoever beats a certain threshold, 12 or 13%, he or she gets on that list. And then at the end of the year, they do the second or third months of the next year, they do a competition, and you're the best fund manager. Your picture is on the magazines, on Forbes, on Fortune 500. So these guys come back all the time. We see that last year, for example, the same guy that was the best fund manager 2017 and 18 was again in 2019 the best fund manager in the US. Actually, it's worldwide competition. Most of them are from the US. Anyways, okay, so let's go back to our chart. So this is obviously, we said, a trending market, a ranging market. So let's analyze this for a bit. Okay, we have the 200 moving average below the price, very important moving average. So it's ideally we want the moving average to be below when the market is going up, and then I personally, after a certain, with my experience, I try to trade as much as I can, go long when the 200 moving average is below the price, and go short when the 200 moving average is above the price. Okay, so it gives me more comfort, and if my comfort zone is high, if my comfort level is high, then I'm more confident, and confidence equals success. Okay, so 200 moving average is below, perfect. And then we see that there is a test of the near-term moving average. This is the 50, by the way, on a 4-hour chart. That's what I use. And then the market starts trending up. Let's draw a line here that I think should be the resistance level. Why? Because there is obviously a resistance here. Yes, a resistance. What we're doing is now we don't have this information here. Okay, so we're looking at this chart here, and we don't have the information there. So we have 1 point, even here 2 points. You can go back to here, 1, 2, and then 3, and then even 4. This is not a full candlestick above that resistance level. And then it's a nice breakout. However, it could have been also an engulfing. This is called an engulfing candle, by the way. It's the sellers were as aggressive as the buyers, and that's why the price corrected a bit. However, when it corrected, it didn't go really low. It didn't go to the previous lows here, because we also have another line here that we can easily also see, and that's the support level here. Okay, so it did not go back to that support. And then here we see a little breakout. It's still not a perfect situation. Not trading is much better in this situation. It goes back, it bounces off the 50 moving average, the near-term moving average, tries it again for a second time, breaks, goes back to the exact same level. Okay, so it's like the resistance shifted from here to here. The buyers are gaining the upper hand. This is what we read from looking at that. The buyers are gaining the upper hand. What does it mean? It doesn't matter. It might be one buyer, one big interbank or institutional bank buying, or it could be many buyers. It doesn't really matter. But what happens is, after we saw that there is the breakout, here we have to assume, looking at the breakout, we have to assume that a higher trend up is starting. Okay, this is the initial phase of a trend up. We have to assume. We might be wrong. Remember, we don't see this information on the right, so we might be wrong, but it doesn't matter. Why? Because if we're wrong, we're trading with our back against the wall. What is our back, or where is that wall? It's the next resistance level that we drew right here, which is at 113 about 60. Okay, so 113.60. So we put our stop loss below that, and we're clear, trailing stop. Okay, so we put our stop loss at 113.50. Where did we go long? We went long around 114. So there is a 50 pip stop loss. That's our maximum loss. And this is where we learned also last time that this is where position trading is extremely important. If we're still not comfortable with this situation, 50 pip loss, I don't want to take a big loss like that. One lot, 50 pips, what is it equal to? $500 loss. Okay, so say I don't want to take that loss, then I don't enter my full size position, whatever my account size is. This episode is about how to trade with less than 5,000. So we saw last time that if you only have 5,000 or less in your account, let's say 5,000, because less is also, you go less, 1,000, you can trade with $1,000, but then you will only be trading 0.10 or 1/10 of a lot. In this situation, let's say we have 5,000, we'll be only trading 0.25, so a quarter lot, right? 0.25, 50 pips. How much is that? That's a $125 loss. So if we're still not comfortable with that, we can also minimize. Why? Because it doesn't really matter. If you're right, you'll add to the position and you'll end up making money. Yes, surely you won't make as much, but you'll end up making money anyways. And this is our goal, right? To build up our account, to go up from 5,000 to 10,000, and then increase our size while keeping the same discipline, patience, and rules, not getting aggressive. I see this in a lot of also students that I coach. As soon as their account size starts going up, they become much more aggressive. They forget about the basic rules, and they start trading a ranging market like they're trading a trending market, and telling me what happened. It was above the 200 moving average, and this is something I see often. So keep the same patience, same discipline, even if your account size is much bigger now. Okay, and then we're back here. Are we still sharing the same screen? Yes. Okay, so the price goes up, it goes back down, it touches our support level. we could wait for that. I personally, as soon as the breakout happens, I go long. If I'm not comfortable, again, as I said, I will go long smaller size. It goes back to my price. I still don't add to the position. Now I want, what am I looking for? Trending market means higher high. So now I'm looking for a higher high. This was the high right here. Okay, this was the high right here. So I'm looking now for a higher high, and boom, this is where it happens here. So here I'm allowed to add to my position. Again, I'm following the rules, right? I'm not, it could correct. If it does correct, what I don't want to happen is I don't want a lower low to happen. So if there is a correction, where's the low? This is the low right here. As long as the price doesn't go lower than that, I'm still, my trend is still good, the uptrend. Okay, then I'm looking for a higher high, higher low. It did not go back to that low, and then higher high again, and then lower low, same thing. Higher low. I always get mixed up. I always mix up with that. So higher low, higher high, and then again higher high. Did it go back did it go back down? Yes, it went back down. However, did it go below the low? No, it did not. Now this, what does it mean? Okay, it might mean that the trend is coming to an end. It tried to go back and do a lower low. However, buyers are still, coming back. So one of two things can happen here. I get out. Okay, how much was this trade? The profits on this trade was, let's say, 14.10. My entry point was 114.10. My exit point is 117.10. That's 300 pips. So that's extremely good. That's a 6-to-1 risk to reward ratio. Remember, we were willing to take 50 pips loss. Okay, so we put our loss 50 pips below that stop loss, and this is a 300. Here, this is where I got out the 300 pip profit. Extremely, very, very good trade. So we identified the trend early enough. Our entry point was right here. Very good, and then the exit point was right here. Okay, so perfect setup. Okay, however, what happened here is it's very important to understand again and be able to read the chart. What happened here was we pulled back. Now this is a support. Remember, 2 points, so we can draw this line right here. Okay, so now this is our support line, 1.2 point, and we are still not sure if this is still a trend, an uptrend market. So we're looking to see if there is going to, if the price is going to print a higher high here, and no, it does not. Okay, what happens here is 2 points, resistance. So the market is shifting from a trending up market to a ranging market, identified by these 2 points as a resistance level and these 2 points as a support level. Okay, so this is our resistance. This is our resistance, and this is our support. Okay, and then we just identified that the market shifted to being a ranging market, so everything changes now. We're not. What I do is I also recommend to my early beginning, as you go through the learning curve, early students, I recommend that you do not trade a ranging market, because it's extremely harder to trade than the trending market. Okay, so don't trade it. As soon as you see this happens, if you're still starting, don't trade the ranging market, but learn from it, watch it, and try to understand it. Okay, so this is the resistance. What does it mean now? We could trade because we have this wall. We're trading with our back against the wall. However, now we're looking for shorts around here and to going long around here. So we're going long around right here, ranging market, and short around right here. However, what happened, and this is what we saw last time as well, what happened here is there was a breakout, right? Last week, fundamental catalyst, a breakout. And I said, this is where I start looking for a long. And I'm still convinced that I never short that, okay? This was a choppy market, ranging market. Remember, we're in August, very thin liquidity equals high volatility. So this might have caused that. Also, fundamentally, the euro is too weak. So it's not really a long market. However, from a technical perspective, this is telling us breakout, consolidation. So we're looking to go long here. However, what happens here is the price dropped back down, went below our wall, so no big deal. I went long, let's say at 1957 or 1960. My stop was at 1890 or 1880. No big deal. I'm out, okay? But had I gone short here, I would have been fighting the market. Yes, I would have made money because it went down. So whoever was short based on the fundamental aspects and the weakness of the euro compared to the US dollar was right. However, from a technical perspective, I'm fighting. So there's a choice to be made. Either I have the technical confirmation or I don't. If I don't, then it's not a perfect setup anymore. Remember, we do not trade unperfect setups. Okay, so let's go back to our slide now that we identified a live. Let's before we jump back to the slide, let's decide what we do here today. Okay, someone's asking, do I go long or short now? Well, we're still above the 200 moving average right here, right? So I'm looking to go long. The price goes back down to 17, around 17. I definitely go long. Why? Because there's a high chance that, first of all, we know that this is a poor support level. Also, there's a high chance that the market bounces off the 200 moving average. So I'm not fighting the market, right? I'm trading according to my own rules. I drew my support level. I'm going long on that, not fighting it. And this is my wall. I'm trading with my back behind the wall. So if it drops below it, my stop is extremely tight, okay? Whereas my reward, and by the way, patiently wait for it to go back down. There's no reason why I would go long here at all. If it doesn't go back down, the hell with it, I don't trade, okay? If it does, then I have a higher chances, higher probabilities, and my entry point is very good. Let's say around 1730. My exit would be around 1870. Very good, 150 pips trade. So risk to reward ratio 3-to-1, yes, because below the wall is probably 50, also 50 pips. So 3-to-1 risk reward ratio is very good. Okay, so let's go back to where to my slide. Okay, yes, we're almost done. Okay, so we're back on this slide. Okay, so this is a breakout. This is what we also saw on the euro last week. And I said I would go long here. And this was a perfect setup. Okay, it was like that. However, it did not work. Obviously, now the euro is back down below 18. So it doesn't really matter. I was confident when I went long the trade and I had my stop loss. I'm okay with that. Okay, so let's go to start with the candle signals. Okay, the candle signals is very important to read, to know how to read. Okay, this is called the long wick. I call it the long wick. Some people call it the hammer, whatever. It's supposed to be green. The hammer candlestick pattern is formed of a short green body. The body is the rectangular body that we see right here. Okay, and there is a long lower wick below it. Okay, and it's found at the bottom of a downtrend. So the trend is the market's going down, trending down, and then this happens. And usually what this means is it shows that there was selling pressure, of course, because we know that it was it was a bearish market. The market trending now means it's a bearish market. And then ultimately a strong buying pressure drives the price back up. So buyers stepped in here. So and formed this candle. That's why there's a long body. It was a red. Remember this candle before it became a long wick or a long tail down candle. It was a red candle, big red candle. This was the size of the red candle. And then during the same period, if this is an hourly chart, so in the same hour, buyers stepped back in, turned it into a hammer, looking like a hammer, a long wick. Okay. There is we can wait for a confirmation. Usually the confirmation is the second candle after that before we go long. Is it red or green? If it's green, it means the buyers won the upper hand, and this might be a reversal. Okay, this is a very important candle to read. Why? Because if there, remember, it doesn't work on a ranging market. Don't go telling me I saw a long wick and I went long. This was a ranging market, so it doesn't really. It's not valid. Okay. However, when there is a trending market, reversal signal means the market might be reversing. There is a high chance that the market is reversing, and we enter at a very early stage. So this is very good. And then now we're hoping that there is a reversal. We don't know where it's going to go, how high it's going to go. We're hoping that it goes higher than the previous low, right? So that it breaks, so it confirms to us that the trend is over. Now a new trend might be starting up, or consolidation. Doesn't matter. We have a very good entry point, and we're trading with our back against the wall. What is our, where's our stop? Just below that wick. You can put it 2 or 3 pips below that wick. Okay, so because then it will cancel the whole idea of a reversal signal. Okay, the inverse hammer. Sorry, I skipped one. So this is the hammer that we saw. The inverse hammer looks exactly the same as the actual hammer. However, it's inverted. So meaning the wick is up. And what this usually indicates is a buying pressure. Okay, there's a buying pressure followed by a selling pressure, but it was not strong enough to drive the market price down. So the selling pressure was not strong enough to give us a lower low. So it's also an indication of buyers coming back in and winning the upper hand. So the inverse hammer suggests that buyers will soon have control of the market. This is a bullish engulfing. This is something that I like a lot because it's usually it's a 2 candle pattern. So in an hourly chart, we have to wait 2 hours for the confirmation. Okay, you can't go in the middle of it. You have to start for the actual candle to form, not halfway through to form, because if there's a half an hour left for the hourly chart, for the candle on the hourly chart to finish, half an hour can change everything. Okay, so the first candle is a short red body. Okay, with disregarding the wicks, it's not long anyway. So disregarding the wicks, but it's completely engulfed by a larger green candle. So the second day opens lower than the first. The bullish market pushes up the price, and obvious win for the buyers. Okay, and finally, well, we're just looking here at a reversal from a downtrend, and now we're reversing towards an uptrend. But the opposite also can happen. The engulfing candle can be, the trend is going up. The engulfing candle first, the smaller body is green, and then the engulfing candle is red, reversal down. So the potential direction, I'm not going to put all the slides here, but this could be also the inverse. Okay, and finally, the evening or the morning star, depending if it's a higher market, the bearish evening is bearish and the morning is bullish. So the bearish evening star or the morning bullish star is a 3 candlestick pattern. So if we're looking at an hourly chart, 3 hours, it is formed of a short candle sandwiched between a long green candle and a large red candle. It indicates the reversal of an uptrend, or if it's the opposite, if it's a morning star, it would be the reversal of a downtrend. And it is particularly strong when the third candlestick erases the gains of the first candlestick. So what does that mean? Here it's not doing that, but when the third candlestick is erasing the gain, so it's much larger, the body means the sellers are taking control, totally taking control. So the potential direction is going to go lower. And finally, the doji, very famous doji. Everybody knows the doji. These are actually 2 dojis. Doji by itself does not mean anything. A lot of people see a doji and say, oh, reversal signal, I'm going to go the opposite. The doji does not mean anything. What does a doji mean? A doji means perfect equilibrium between buyers and sellers. Nobody is winning the upper hand. So there is a perfect equilibrium there. Let's say the euro at 118 forms a doji. What it means basically means the buyers and the sellers are equally strong. It does not tell us if the market is going up or down. So we still don't know. We have to wait for a next candle after the doji. And this is a very, very important signal. If we see a long tail down, like for example here, after the red doji, we see a long tail down, buyers are winning the upper hand. So we have to read the second candle after the doji to know if it doesn't mean, and if it's just a candle and that it doesn't look like a hammer or anything else, forget about it, okay? But if it does, then it's a very important indicator of a reversal in trend. Remember, we're also looking for a trend reversal here. So if it's a ranging market and you see all this, doesn't mean anything, invalid, okay? Next episode, important psychology, interpreting candlesticks and hourly and 4-hour charts, what the difference is. This is the secrets of support and resistance levels. We are already going through the support and resistance levels. However, next episode, we're going to see why they're so important. People don't look at them. People just follow some. There's nothing wrong with that if it works for you. RSI indicator, MACDs, Elliott waves, all kinds of, you're going to see all kinds of webinar. I like on technical analysis, I like to keep my technicals very simple, and I love support and resistance levels. Why? Because they are my, my backup in case it breaches, I'm out. So I'm always comfortable when I go in a trade with knowing what my maximum loss is. Any questions? Okay, someone's asking how they can be in touch with me. I can, well, I have a Twitter account that I'm very active on. Rony, this is my Twitter account username, and you can also get in touch with me via email at SquaredFinancial.com. Yes, Telegram group. Also, we have a Telegram group, Squared Financial. Okay, we have also a Telegram group in Arabic. للي بيحكوا عربي عندنا Telegram group in Arabic. Soon we're going to have one in French. In Spanish, we have a Mexican office, so we're going to also, expand in that in these languages as well. Any other questions? Yes, it's Squared Financial. Just go on Telegram group and search for Squared Financial. Okay. Thank you very much, guys. Have a nice end of day, evening, morning, wherever you are in the world, and hope to see you next Wednesday for our support and resistance secrets episode. Have a nice day. Bye, Kareem.